Okay, welcome everybody. Welcome to the product tanker panel. Very pleased to be hosting. My name is Turner Holm. I'm head of research in Clarksons Securities and new to covering the shipping space, although I've been around it for a long time in Clarksons. The heart of global shipping as we are. So very pleased to have all these esteemed panelists with us today. Starting at the far end of the table, we have Meldgaard from TORM, CEO. Robert Bugbee, who is president of Scorpio Tankers, needs no introduction. Mikael Skov from Hafnia. We have Carlos de Mottola from D'Amico. And we have Anthony Gurnee from Ardmore Shipping. So we have the titans of the product market with us today, so very pleased to be able to host this. Product is probably the hottest segment in shipping at the moment. I think that's fair to say, when you look at the rates. Product tanker rates are sky high. The stocks have been the best investment of all segments, sub-segments within shipping this year. We've seen stocks double, triple, and even a bit more. So it's been a good place to be. I think the key question for the panel today is can this be sustained through next year, possibly even longer? And if so, what are you going to do with the money? So I think those are the kind of things we're going to talk about. I will say product, it's a bit of a mystery for many people, I think. It's crude is somewhat more simple, and I think a lot of people look at product and think it's complex. And I'll say, you know, looking at the magnificent run that we've seen in the rates, and the stocks for that matter, you know, in preparation for this panel, I was just, you know, calling around to a lot of colleagues and asking everybody kind of what is really driving this, yeah? And you get a lot of different answers. I think a lot of people are still figuring it out. And so I think it's really good to have these distinguished guests with us today to talk about that. So I think I'll open it up with that to just talk about what is driving this extraordinary surge. And I'll start at the end of the table with Meldgaard from TORM. How did we get here?
Well, thanks for giving me the first stab at it here. I think we are asking, obviously, everybody on the panel here, pinching our arm and saying, okay, what has led us to where we are and how long will it last? The analysis that we made so far is that the drive in the market is not because of increase in volumes. If you look at this year so far, probably the traded CPP volumes is up by about 1% year on year on this year to date. If you look at the ton mile, it's also not significantly up. But if you look at what we would term the ton days, so how long time does it actually take to take a ton of cargo from A to B, including of the loading and discharging, then that is up about 5%. So that's for the steaming time when you are actually loaded. And then the ballast leg is up for about 7%. So all told, it means that on the demand side, you've seen an increase high single digit overall because of this. And then on the supply side, the natural tendency is obviously that the fleet would remain the same. However, this year, cannibalization from crude carriers so far is down by 2 to 3%. So when you add it all up, it's actually a step change, close to 10% for the product tanker market. And that's why we are here today. And I would argue that even though that Putin does take a lot of credit for a lot of things in today's world, it is not because of Putin that the market is so strong.
Yeah, I've seen some of the same data in the Clarksons number. I think that that's one of the mysteries as well, is that the volumes are up. I think you said reference to numbers that were up 1%. I think I saw year over year from some of the Clarksons real-time shipping data using sort of satellite tracking and everything. It was up about 4 or 5%. So, and especially lately, we've seen a little bit of move up. But it is a bit of mystery. So I want to dig in a little bit further with that. But before, maybe I'll just move down the table. Robert, why don't you tell us about where rates are? Tell us about the journey from earlier this year to where we are today.
Okay, we turn the year with MRs, modern MRs, around about 13,000, 14,000 a day. A lot twos, 14,000 a day. Then we steadily increased through to February, just before the invasion in February, through to about 18 to 20 on MRs and 20 to 21 on LR2s. Today we sit at anywhere between 40 and 60 on MRs, and we're fixing with an average, let's say, of 45, 47, and on LR2s 50 to 90, with an average somewhere at 70.
Yeah. Yeah.
And that hasn't been a steady move. You've had, move upwards, consolidating downwards, move upwards, consolidating down. But on a technical basis, it's been very strong. Every dip has been to a dip, creating a higher low.
Yeah.
And every high has been to a higher high, and a greater breadth in the market. Earlier in the year, it was sort of one or two areas, and now it's across the distance.
Yeah. Mikael, so I think Jakob from TORM said that this isn't just about the war, and we had this discussion just a minute ago as well. To what degree has the sort of Russia-Ukraine situation affected the market? And, to what degree is it, do you just sort of judge that this is a function of other events, longer-term structural changes in refining capacity and trade patterns and those kind of things? What do you kind of put this big move down to? How would you explain it?
Is that me?
Yeah, that's you.
Oh, okay, thanks. No, I think, as Jacob explained, coming into this year, there was already pretty good fundamentals, indicating that we were going to see a stronger market than last year. Obviously, when you cut off short-term transportation of oil from Russia into Europe, and by the way, we haven't seen all of it yet. We're going to come into sanctions here in December, and then products again in February, which basically will take out the last 750,000 barrels per day. So there's more to come of oil that used to go 4 or 5 days from Russia into Europe, now being replaced by voyages coming from the US Gulf, from the Middle East, India, and Far East. So there's no doubt that a already strong market got kind of pushed into full utilization by the situation we've seen. But I think what's important to keep in mind of this is that it is not just now a temporary thing due to a war. There will be structural changes to oil and gas going from Russia into Europe in our view, and therefore we don't think that this is something that just goes away in a ceasefire situation and end of war. We are looking into an area going forward where supply of ships will be limited because there's a low order book and no new ships can come before 2025 that you order today. Low inventories, an already saturated market. If you add on top of that a structural change of longer ton mile because of the oil you take away from Russia into Europe, I think you're looking at a fundamental change that will keep this market going for quite a number of years.
Yeah, for sure. We'll get to next year, but I guess there are some big changes, and I may get to that with Anthony, but I want to take quick on inefficiencies with Carlos, if that's okay. It seems to be a contributing factor, right? We have utilization now, I think I maybe have mentioned it, but it's the highest in 20 years, at least, 92%, basically a fully utilized fleet. That's even higher than what it was in the third quarter of 2008, which was the previous peak. That's saying something, right? It's not a lot in shipping, it was higher than what it was in the third quarter of 2008. But could you talk about any efficiencies your company may be seeing at D'Amico, or do you think that that's a contributing factor? And are these things that are going to stick around, or are they going to go away? What do you think?
Yeah, I agree. Inefficiencies are playing a big role. Usually trade would tend to happen in the most efficient way possible. And of course, when there are sanctions that come into play, they change what the optimal trades are. And in particular, in this case also, what we are seeing is that a lot of the Russian product is moving anyway and arriving at the destinations it was arriving previously, but in an inefficient way. So it would go to countries which are, let's say, neutral or a bit more ambiguous in their stance towards Russia, and from there they are blended and re-exported. But they do seem to find another home, and then often what we are seeing also is a lot of transshipment happening. So that lengthens the typical voyage, and it is definitely a contributing factor. It is happening in some regions it's happening in many regions of the world, and you see also out of Fujairah that the waiting times has increased quite a lot. But it's happening also in the Mediterranean and in the Baltic, so it's quite widespread.
Thanks, Carlos. Anthony, coming to you. I think even before the war has contributed in some form or another. Maybe that hasn't fully played out yet. We'll talk about that. We talk about this sort of broader landscape, I guess. You know, there's been pretty much the same story for many years, where you have European refineries that have been closing down, opening more in the Middle East. There's some big coming there, in Asia to an extent as well, and so that sort of creates these longer distances and more ton miles and more demand for the ships. Can you just talk a little bit about the broader landscape here? Do we see any changes with that story we've heard for a while? It's really interesting, I guess. European refineries must be getting hit pretty bad by natural gas, for example. They use it to refine for diesel, and obviously natural gas prices are very, very high in Europe, catastrophically high, really. That can't be good for them. But maybe you could just give us a little bit of update on that story we've heard in product for a long time and how it kind of looks from here.
If it's okay, I'm going to answer a different question first.
Sure. Okay. All right.
Which
go for it.
is kind of to kind of build on the discussion we've had so far. And I think, as was pointed out, right now MR rates globally on average are maybe 45,000 a day. But that doesn't mean that every ship everywhere in the world is earning 45,000. And I think it's interesting to note that, reflect on the fact that when it really kicked off in March, we initially saw a spike in the U.S. Gulf and in the Middle East, and then that really began to spread around. So at the moment, in the West, rates are probably 40,000 a day. Arabian Gulf is 55,000 a day. South Asia is 65,000 a day, and North Asia at the moment is 90,000 a day.
My estimates are coming up.
So
just raised them on Monday.
So I think when we think about upward potential in this market through the winter, when we have such a anticipated disruption with the continued rollout of the impact of sanctions and typical winter impact, I think we need to lift our eyes a little higher than 45,000 a day. So just wanted to make that point. Also, maybe it's also worth mentioning that at the moment, even at 45,000 a day, freight is only about 5% of the value of the cargo being shipped in our business. So it's not like freight's going to choke off demand.
Yeah. Well, since you raised the topic,
Yeah.
what could happen in the winter, right? I mean, shipping stocks are often very momentum driven. The rates go up, the stocks go up. So everybody's interested to know what could happen in the winter. I know we wrote about it this past week, and my colleague Frode Morkedal was saying that I almost don't want to repeat the number he said because it could be so high.
Right.
But what are we looking at in winter, especially as this Russia embargo from the EU kicks in December?
I don't think there's any practical upward limit.
Yeah.
Because again, it's not, the freight cost itself is not going to choke off demand. So let's see what happens.
All right.
But going back to the question, maybe I'll move on from there because I don't want to.
Yeah, who wants to take that? The broader landscape. I mean, we were talking. I mean, like I said, it's been a similar story for many years, but I guess it's still true. Anyone who wants to answer that, Jakob?
Certainly. As I mentioned before, if you sort of argue that it's about 5% increase that we've seen on ton days, then about half of this is imports into Europe. So that would be about a 2.5% uplift. Then you've got Latin America, which would be accounting for another 2.5%. So there in Latin America is both that you are getting cargoes from further away and that you've got logistical issues in that area. And finally, you've got a couple of pieces that are moving in each direction. You got Australia, New Zealand ramping up by that they increased their imports by about 20%, which adds another 1%. And then finally, you need to adjust for that Asia in general have been a little more slow, and that is a decrease in the demand picture of 1%. So it is actually the key drivers are the two phenomena that you mentioned before. One, refinery dislocation, and two, which is Europe predominantly, and Australia, New Zealand. And then the other thing is this inefficiency in the value chain, especially in Latin America, where you've seen that the time to get the cargo out has been on the increase, and at the same time, we've also had longer distances. So that, I think, is a good proxy for how it's played out right now, and we don't really see that any of these factors are not there to stay. And as a couple of my colleagues pointed to, then from February next year, there's no doubt that I think we will see an increase in the demand following the EU sanctions taking into play, because you've simply not seen the diesel that is normally moving from short haul from Russia into Europe. You've not seen a real decrease in that. It is more or less at the same level as it was pre-war. So that is all for us to come, that you will need to take diesel into Europe from further away from US, Middle East and India.
Yeah.
Can I add just to
Please,
some of that as well? Because I think one thing we haven't spoke about is, we talk about rates being 50 to 70 to 90, etc. And I've seen quite a lot of people trying to analyze around what if ton mile goes up by another %, then how much do freight rates go up? And I think it's just important to underline actually what Tony said is that once you reach, as we have now, which is a technical full utilization, basically means that all ships are sailing and there are more cargoes than ships in general terms. What makes rate go up is actually the sentiment and the commercial negotiation that goes on every day, where people push and push and push, and at some point certain cargoes don't materialize, and then it drops off a little bit, as I think Robert said, and back up again. But it's not a mathematical thing. Once you have full utilization, there's nothing that prevents rates to go to any level other than, as Tony mentioned, if freight becomes so much out of the total transportation that it kills it, then you'll see the consequence. But even if markets should go to, I think LR2s were mentioned by you actually, $250,000 per ATC. Yeah, that will probably only be about $13, $14 per barrel of oil transportation cost. And in that context, that doesn't kill trade. So it's just to make sure that people understand that there's no real cap on this situation other than once rate becomes really, really high a percentage of the total cost.
I think another important point, and it's been shown in this last weeks and months, is that the owner's ability to drive prices up when that volume comes in and drive it up fast is very, very high. So in the times where the cargo hasn't been there and you've had that backing off, the market has drifted down slowly. But as soon as the cargo is back in, you see this pattern where rates drive out extremely fast. We saw the US Gulf market go from 15 to 45 in about 4 trading sessions. We see the LR2 market out of the East many times just take 4 trading sessions to go through $40,000 a day. Part of that is not just that you've got basic high utilization, it's that if you just take the 3 companies that we have here, nowhere else in bulk shipping do you have as high a percentage of commercial ships under one group. I mean, between the 3 of us, our percentage of total spot product tankers is very, very high. And that's because we don't just trade what we own, we also manage in pools other people's assets. So compared to the largest crude oil carrier companies, compared to the largest dry bulk carrier companies, the actual deadweight held in any point in the spot market is very, very concentrated in the product market. And if you then put on top, overlap that with the amount of tonnage controlled by certain key traders, you get an even more concentrated market. And the other thing to understand is that in bull shipping markets, traders actually become owners. That they are happy with rates being high. If they've chartered in some ships last year from weak owners or people that had to charter out for 14 a day on MRs or 17 a day on LR2s or something, they love it this year that they're making money. They're making money totally onto their own trading books from this. And that's a very important dynamic that is sort of, largely, overlooked by investors or analysts, and why would they know it anyway?
Carlos, I wanted to talk about what we see in the spot rates. So we've heard a lot of big numbers thrown out here, and they are big numbers, and they just seem to be persisting. Robert described the journey through the year, and there's been upward surges and some consolidation and then back up again. We've seen less of that movement on the long-term charters. D'Amico has a significant chartered in bareboat fleet. What are you seeing? What kind of moves have you seen on the sort of longer-term charters? And how are you thinking about that as a company?
Yeah, we usually tend to have more of our fleet covered through period contracts, but when we saw what was happening in the market, and it was quite easy to understand in which direction the market was going to be moving over the course of the next few months after the war started, we decided to not put any more vessels on time charter out, and therefore our coverage started falling very rapidly. I mean, we are only 20% covered in the last quarter of this year, and 6% covered for next year. And what we are seeing over the last few weeks is that finally charterers, which were being very unrealistic about the rates that should be paid to charter vessels, are coming to terms with what the market is. And we are seeing numbers which are interest in chartering at numbers which now start to make sense. And by that I mean more than 30,000 for 1 year for an Eco MR, and more than 40,000 for 1 year for an Eco LR1. And at these numbers, we might take some additional coverage, although we are not in a hurry to do so, because we are very positive about the market going for not only for next year, but for the next 2-3 years.
Tony, you want to talk about term coverage or spot? How are you thinking about chartering?
We think of 1 year TC as kind of being a substitute for just spot trading, and it's just a view on the market. I think at the moment, maybe the 1 year TC rate is 30,000 a day, 28, 30. But we think, the next 6 months we should be earning well in excess of that. So you have to think about what are you giving up on the back half.
Sure.
And then you can apply the same logic to future years. In reality, normally the multi-year time charter market in our business is quite thin. We expect that that's going to start becoming a more kind of a popular thing for charters to do.
Are you seeing that?
Beginning to.
Yeah.
You have to think about, counterparty risk, et cetera. But no, it's probably going to build through the winter. And, I think you'll probably see some companies begin to take cover. So.
What do you think about next year? I mean, as I started the panel, opened the panel, the question is, can this be sustained? The general mood seems to be that it's not, at least not slowing down, and perhaps as we get into the winter, maybe even accelerating. But stretching it a bit longer, what do you think? How long can this last? I mean, the order book is not really existent, frankly. I mean, there's very little order book, right? You could see with a little bit of scrapping, you could see zero, maybe a negative effort, some people claim, but very limited in any case. How long can this last? Did you want to give a quick stab at it? Sure, yeah, continue.
Yeah, so I think one interesting thing is that we by no means made a full recovery from the pandemic in terms of oil demand. So jet fuel demand is still 70% pre-pandemic, et cetera. So I think there's still some just recovery demand that's yet to come. Obviously, there are cross currents and countervailing points in terms of the economic outlook, on a macro level. But it's not clear, obviously, what's going to happen next year. But you could easily see demand remain quite strong in our business.
Sure. Jakob, what do you think about next year and even beyond, if you care to guess?
Yeah, well, I think we've taken the stance that we actually don't know what is to come, and that in an environment where you are uncertain, then for us it's better to be having no cover rather than making a call on whether 30,000 for a year is a good rate or a bad rate. So I think that we will be much more informed collectively, let's say sometime in Q1 next year, at the point when you've seen the recalibration of the trading routes that will have to still occur following the EU sanctions that I'm still a personal believer in that will come into play. So I think until that point, I think the market will be very volatile. I'm generally very positive at this moment, but at the same time, none of us a year ago would have foreseen that we were sitting in this market. So you cannot rule out a black swan.
Sure.
It's probably quite difficult for us to understand what it would be currently, but that could be the case. Until then, we are all in for the spot market and believes that is the right place to be.
Yeah. Anybody else want to go? Robert, you look like you have something to say.
Yeah, it's like, I think we should start to get real a bit. It's like, the room is not full, okay? So we know the market hasn't topped out. When we know, we've seen it many times. We saw it in, the late 80s, we saw it in 2007, 2008, we saw it in 2015. Whenever a panel is presenting and people are standing here, which they do, and they're standing in the doorway because they can't get in, and they give up getting in, so they stand in the bar. We learned by now that that's the time to start thinking the market is topping. We haven't even yes, we can have a black swan. We don't have a clue whether, something really stupid is going to happen, and we're probably better off not worrying about something really stupid is going to happen anyway. So let's first start getting real about the situation. We've had the US pumping oil into this market like crazy with its SPR releases for months now. We've had China kind of in slowdown and lockdown. We've had European airlines unable to fly the flights that they've got booked. And still the world has still been totally unable to build its commercial product inventories at all. You're now entering the period. You've had deliveries of vessels. We've still had the crude oil market being so bad. You've had VLCCs earning less than Handymax product tankers. So when they've been delivering from the shipyard along with Suezmaxes, they've been poaching our cargoes through the summer too. We've even, as Jakob says, had some transfers with some of the more modern LR2s that were trading in crude cleaned up and claimed into products. But despite all that adding to daily supply, the market has marched on upwards. Now that's not happening. The VLCC market is strong, so you won't have that handicap. You don't have any deliveries now. Ships don't really get delivered in November and December. And yet we are facing winter. It is one thing to go into summer with low inventories, especially when things are working there. It's yet another to go into winter with low inventories when these rates are where they are and utilization is where it is. Just like Michael's saying, it's like the market will bear whatever it's going to bear because the cost of our cargo is so high and the cost of transportation is so low, and the customer himself is actually making money in these trades. No one blows up with our chartering guys if they charged, all of us have fixed ships at over $100,000 a day this summer on individual voyages. Not one time have we had phone calls from the heads of the BP and Shell shipping ringing up and saying, what the hell are you doing screwing our guys over? Of course not, because they're making loads of money at the moment, the traders and the oil companies. So you've got a lot of price inelasticity. And you've got this wonderful sort of thing where the only mistake even we have done in the last 9 months and last year is we haven't been bullish enough. We have underestimated the strength of this market at all times because even we've been afraid to believe. Half the governments in the world are not afraid to believe, they're just not facing up that there could be quite a crisis related to energy. So even if you don't have any more developments in Russia, you're facing winter, which will come in this situation. We ourselves have no idea what is going to happen if you take this next stage that Jakob, Mikael, Anthony have been speaking about. Are we going to be taking handy carriers from Russia to Brazil? What's going to happen? Ice-class MRs, are they going to that route? Are we going to substitute Europe from Saudi Arabia or North China? Who knows? But when you're up in these low 90% of utilization, just a small change to the positive can lead to dramatic results. It is important, the outliers. It's great. If you have a market that's averaging, let's say 40, 50, but you have the odd voyages at 100, that does an awful lot to your actual numbers. So here, we don't know where it is. We're seriously excited what's happening. We're worried, of course, that there could be a black swan. Everybody should be in this type of world. But the actual product market itself, once again, as we sit here in front of winter, the risk is to the upside, not to the downside. The customers are accelerating their demand for upside. The important point that Anthony made and Carlos made to time charters is that 3 or 4 months ago, there were not 3-year charters. Now there are 3-year charters, and there are negotiations on 5-year charters. That means the customer is there looking into the long term because of the fundamentals that are there. And, you know, that's before you get to the fact that next year you've got environmental regulations. They're going to reduce the capacity because of the ton miles. I mean, none of the analysts are really talking about that properly. It's like, you know, it's like as a group, not necessarily Clarksons, but as a group, they're kind of afraid to really say what's going on.
Yeah, I mean, we just raised our estimates. I'm looking at consensus. Seems like they're not keeping up with the spot. I think that's fair to say. Let's come to the stocks. I want to make sure that we get time for that, and maybe a few questions as well. First, I mean, you said, okay, I want a question to Hafnia. You have leaned into this, yeah? So tell us about kind of how you've been positioning yourself for the strong market. You made some acquisitions. Tell us about your thinking there, and maybe what you think about values as well, right? Because we've seen the spot been very strong. Seems like a consensus among this panel that there's no massive sustained pullback, and we could see some consolidation, but generally the things look pretty good. Term charters are coming up. They're still quite a bit lower than spot, but coming up. Well, tell us a little bit about your acquisitions and I guess how you're feeling about that now. I assume it's good, and just thoughts about values where they are now.
Yeah. Yeah, well, I think first and foremost, the acquisitions we made last year was obviously not made on the back of us thinking that we're going to be sitting in a market today as high as it is, but it was actually, they were made on the back of us looking into, as we've all mentioned here, you know, strong market fundamentals, but really more important, an order book that's low, and even more importantly, the inability of people to spend money today ordering a new ship and get it delivered in 18 months. So I have never seen in my time in this market that you are unable to spend the money you make on a new built ship that will then be delivered in the foreseeable future. It has always been this way that you make money in a strong market, second-hand prices go up, they go above the new build parity and replacement value, and then you start moving over and you order a new build and it comes in 18 months. And then down the line you ruin the market because basically there's too many ships when the market goes quiet. So, and I'm not saying that we are more disciplined today than we were 10 years ago, because I actually don't think we are, but it doesn't matter because it can't happen, because you just can't get the ships. So I think second-hand values, although they've gone up since, well, the end of Q2 actually, probably by 20% already, I think there's a lot more to go, because as you start making more money as you go along, As Robert said, as you start getting more environmental regulations, there is really only one place to go if you want to modernize your fleet and make sure you have longer time to work in, and that is to buy second-hand ships. And still, when you look at the alternatives, there aren't any. So I think second-hand values have only probably just begun the voyage. In a very strong market like this, I'm convinced you're going to see a lot more uptake. And what really makes me positive and why we're happy about these 44 ships that we bought is exactly for that reason, is that we can't ruin the market even if we wanted to. And just, it's really important that people remember this, that every single time our market has been bad, it has never been driven by lack of demand. It has always been driven by an oversupply of ships. And that's the biggest difference that we're seeing this time around compared to any time in history, really.
Carlos, what do you do here? To sit back and, to build on the point from Hafnia, just looking at the Clarksons data, the ships are still, with maybe resales being an exception, at or below new build parity. I mean, and I guess when we've seen these segments really have blowouts and rates, like we saw with container earlier in the pandemic, they go far, far above new build parity because of the excess cash flow that one can get in the near-term market prior to delivery. But what do you do? I guess we're getting to time, or we're getting closer. I want to hear what everybody wants to do with the money. Carlos?
Yeah,
what do you do with the money?
Yeah, what to do with the money? Good question. Good problem to have. No, we were fortunate. We had some very interesting opportunities this year to redeploy some of the money that we are making already. We agreed to buy out a JV partner in one of our JVs at a very attractive price just before asset values started moving up quite fast, and we closed the deal this summer. And then we have purchase options on 2 vessels which are in yen. And so in addition to the asset values moving up very much, we also had the very weak yen that helped us. So we exercised one of these purchase options recently. And we have another one which we are very likely going to be exercising. And we paid around 30 million for a 5-year-old MR, which is probably worth around 40 million today. So that was quite a good investment, I would say. And then we have a number of other actually options to buy vessels that we TC in, which are maybe not as attractive as these 2, which are denominated in yen, but which are still in the money, and which we will look at carefully down the road. And then we will look to deleverage, because for us it is important to use this moment to strengthen the company, so that when the next down cycle happens, we are in a position to take opportunity of that. It's going to require patience, because the next down cycle is going to take quite a few years, I believe, to materialize. But we have to be in a position for when that happens, that we can make the most of it, and we
sure.
did.
I mean, I guess everybody here has been through a tough market, and I guess deleveraging is a priority to a degree for everyone. Has been for many companies the main priority this year. But just to make sure we get around to everybody, Ardmore, Tony, what are your capital priorities?
Yeah, it's very simple. I mean, we've had a capital allocation policy for a few years now, and our top priority has been deleveraging down below 40%. We'll more than meet that target by the end of the year. After that, we'll probably pivot to paying dividends again, and you just keep on paying down debt. And I think it just feels that asset prices have risen so rapidly. I think we're just very busy, spot trading ships and also working on our energy transition plans.
Sure. Yeah. TORM. What do you want to do with the?
Yeah, so we feel actually very comfortable with our current deleveraging ratio around 40%, and I think that's based on public figures at the end of the second quarter, so that has gone lower by then. So that means that the excess cash will be basically rewarded back to shareholders' distribution. And yeah, I think that is the right policy for a company like TORM, to simply be rewarding shareholders at this stage of the cycle. I don't see a need for reinvestment. I don't see a need really at this stage to delever further.
Yeah. I'll jump to Hafnia. Robert, you can go last. You can go last, Robert. You can finish this off.
What, me first, you mean?
You first.
Oh, okay.
Let's do Hafnia first.
Yeah. Yeah, but really, I mean, I don't think there's so much different to say compared to the others here. I mean, you know, we are where we want to be on the balance sheet side. We don't have any future investments. We have completed our growth strategy. So it's really returning capital to shareholders. That's what we'll be focusing on going forward.
Robert, I'll save you for last because it's a bit of a mystery what you're going to do. I guess you have this third quarter conference call that's going to come up. I think previously you said that you were going to sit down with the board, I guess sometime around now, really, and figure out what you were going to do, but you hadn't decided during the summer. So I guess you're not going to give it away, but I don't know. What do you want to say here, Robert? What are you going to do with the money?
I don't think we promised we would say what we said in the board meeting, but we're going to continue doing what we're doing, which is, you know, increasing liquidity, lowering debt, and taking opportunistic positions to buy back stock, you know, under net asset value. I mean, I think that that's the, you know, I think that we learned in the last cycle that you want to put yourself in, take the opportunity to put yourself into incredibly strong positions. We've got a situation where we haven't got any capex because we've got a new fleet with no new building orders. So if you press the debt down, increase the liquidity, and just be a little bit patient, you can really do a lot of things at that point in terms of rewarding the shareholder once you've sorted, you know, that position out. But we've already started. We already feel confident enough. We've been buying stock on weak positions. So I don't think it's a mystery. We've been doing what we've been doing now for a few weeks. And whilst the stock is trading so far below what we consider the net asset value is, then that's the best alternative.
For sure. Time for one or two quick questions. Any questions? The panel? Hottest segment in shipping. Any questions? Okay. Okay. Then I mean, Robert, you brought up a point. I mean, NAV, trading at NAV. I think that's a question, right? Are you trading at NAV or are you trading below NAV? You've highlighted what you believe. And I guess, look, you know, time charter rates are going up. Most of the assets are still at new build parity. And new build prices have gone up, but that's, you know, and asset prices have gone up, but again, new build prices going up as well. So adjusted, you know, replacement costs is really doesn't look too challenging from an asset value perspective. So what do you think? I mean, how much a discount do you think you're trading at? I mean, where ship value is going? How do you want to answer that?
Look, we look at third-party data. Okay. First of all analysts by definition are behind in their starting point at this point. We're closing the third quarter. It's closed for all of us already in terms of revenue, really. We're working on the fourth quarter. But if you see, the analysts have to use the balance sheets on June the 30th. So they ignore all the cash that has been built between then and now. That's the first error. The second error is that all you need to do is look at vesselvalues.com, and the values have been increasing.
Or Clarksons.
And they started with a Clarksons, and they started with a lower NAV anyway because they felt they needed to be conservative. So you have a compounding of the compounding. And if you take certain companies, if you had a company that is earning, you know, it had an NAV, the analysts thought they had an NAV at 20. But really the NAV was 24 on June the 30th, and they've probably earned $4 in cash since.
Yeah.
Then, you know, the NAV is 28 already, plus a 10% appreciation, or 5%, let's play conservative, 5% appreciation in values at a 50% leverage. Already that valuation is at 32.
Yeah.
So you have big wide differences to NAV on some of these companies.
And you stretch it out as well, right? We were running this exercise on the desk earlier this week, and if you look at the rates that we see in the spot market, and you look what happens to the NAV by the end of next year, it's a big move. I think people might be shocked if they looked at.
I mean, look at take his company. What's your market cap?
So thanks for asking.
Yeah, it's good. I'm long your company.
About
From
1.7
self-serving personal position. What was it? 700 million? 800?
1.7 billion.
1.7 billion. Okay. So he fixed an LR2 tomorrow at $75,000 a day for 50 days. So that's 60, 70. It's not bad. That one fixture changes his NAV a reasonable amount for the week.
Yeah, we looked at the numbers. Tony, you had a comment. You had some thoughts.
Yeah, it's just pretty much the same point that I think it's not. I think the real driver of NAV right now is actually the cash accumulation.
Yeah.
So even for us at $10 a share, based on the analyst estimates, we're going to make 150 in the third quarter. Fourth quarter market is already higher than that. So there you're probably talking $3. So.
Transformative for the balance sheets, transformative cash flow, it's transformative for NAVs if this continues. So it's going to be very exciting to watch what these gentlemen can deliver through the second half of this year and also into next year. So I just want to thank everybody. Round it off with that. Thank you.
Thank you.
If anybody has a question, we'll answer it. If not, I think we'll take a break. Okay, there's two questions here. Question here, yeah.
Hi, gentlemen. My name is Joanne. I'm from Gaslog, and I'm head of HR and ESG. And I wanted to ask you maybe a slightly different question. So obviously, you're all very excited about how well the sector is doing. And typically, we know what you do with all the money is shareholders, investment, or balance sheet. And I wanted to ask if you are intending on doing anything more with regard to your ESG programs, the S part of ESG being social, giving back to some of the people who are hurting in our societies in any way. I mean, I'm just wondering if you obviously have ESG agendas, and are you thinking about increasing what you do in that respect? I know you are, certainly. Absolutely, I know you are.
I know Carlos is, because it's in the family. Yeah, the family is taking care of itself, I imagine, in D'Amico.
We do it as at the group level, so including also the private companies in the D'Amico group, but also at the DIS level. There's a lot of attention to many aspects of ESG. Of course, the environmental aspects, and in that respect, one thing that we are doing, which is not necessarily giving back directly, but indirectly, I would say, hopefully, is we have been testing biofuels on our vessels, and we have tested 30% blend biofuels. And with very good results. And now we're testing 40% blends, and we want to reach 50% blends. And so hopefully that is a drop-in solution, which is not very difficult to implement, and which can help reduce CO2 emissions. We work also a lot, of course, to make our vessels more efficient from an operational and a construction perspective all the time. But all the players here do the same, I'm sure. And we do a lot in terms of helping with the education of cadets in Ireland, where our companies are based, and so we are very involved also on that front.
I'll just jump in a little bit. I mean, I think we're all engaged in various aspects of the energy transition, but we're constantly investing capex in energy savings devices for the ships. We're very, when it comes to seafarers, we're very active with the mission to seafarers, raising funds for them, not just giving money, but actively engaging in campaigns. We've already got a very diverse staff. One of our concerns at the moment is the impact of rising energy costs for our European-based staff, and we're working on that as well. So I think we'd all like to think we're doing the right thing. So.
Yeah, I would argue that it's a very good question, but I would argue that it's the responsibility for all of us at any given time, whether you have windfall profits or whether you are under normal circumstances, to play a role in society where you are active. And in our case, we have for years been supporting the education in the Philippines of really the poorest that you can identify. So they will not be part of TORM, but they will simply be offered an education instead of working as child labor. And I think that's our way of giving back, but it's not really related to whether we make a profit or not.
Okay. All right. Thank you very much. Thank you.